Welcome back. In this video, let us discuss how to create a financial model for the given case study of financial analysis task. Okay, so let us see the task. So this is a task and this is the requirement that is given. Already we worked on two different phases that clearly speaks about our key requirements, like we are supposed to create a financial model for calculating for a green tech manufacturing company, and we are supposed to calculate NPV, IRR, and we also assess sensitivity and scenario analysis, and we address 12 important questions that are given below. Okay, so these are the 12 important questions, case questions that we are supposed to calculate and interpret it in coming week. Maybe we will be working on writing a paper on this. Okay, so anyhow, the model that we created should address all these questions, and input values are given here. So project details and assumptions, and using these values you are supposed to calculate these things. And one more thing is here it is clearly given that the spreadsheet model should contain four modules or sections. One section is for input parameters, another section is for decision parameters, third section is for outputs, and fourth section is for calculations. These four sections should be included in your paper. In addition to that, maybe scenario management, we will be creating a separate sheet, and sensitivity analysis we perform within the calculation sheet. Okay, so let us create four sheets. First one is input parameters. So you can change the name. However, decisions, decision parameters. Okay, next outputs, next calculations. Design for by making it easy for change parameters can be expected. So these are some parameters. This contains parameters. These two sheets contains our work. It's a very simple model. You don't get panic and don't take unnecessary time. First, listen complete video once. Take 10-15 minutes of time for which this video gets completed. Completely listen first. After completing the task, you just understand what I am doing in the sheet, and start working on preparing your financial model. Got me? So I will open this sheet. I already downloaded it. So here I downloaded it. So I'm opening this one, and let me minimize this. I will take all input variables to the values that are given here. Just I'm copying it. Okay. So let me take them in input parameters. So just frame it properly. Otherwise, I suggest you one thing, whatever the data that is there, um, up to here. So in like this, in these areas, you can use ChatGPT properly. Oh my God. Okay, up to this, copy and go to some ChatGPT and give it and give space, rewrite them in a table. These values are inputs. Financial model. So it automatically creates a proper table kind of thing. Okay. So it's up to you. You want to take everything, or you just want to take these three columns. So first I am copying it, and mm, this simplifies it like this. Okay. I'm removing everything and just pasting it, and I don't want this column actually. I'm nowhere it is explaining in my document. I'm just resizing this, and just readjusting values. Again, cross check. This is accounts receivable 30, it should be a number. And this is 30 days, it should be a number. So like this you can take actually, you understand. So this should be a dollar price. Again, I will be formatting it. Got it. So and 10% of COGS, cost of goods sold. Okay, nice. This is percentage. And option two, equity 30%. So let me take one more option here. Okay, one more debt equity. Okay, so this is 70% and this is 30%. Okay, I don't want this. Option one is 100% and I will rearrange this one. This is equity and 100%. This is clear. Debt, interest rate on debt. We have two options, option one and option two. And in option one, we take 100% debt, and in option two, we take 70% debt and equity 30%. Usually, the interest rate on debt is 5%. Okay, so this is the value. This is 10 years. This should be a value. Method straight lines. Okay. Inputs 16,000 per year. Remove it. Okay. So price per unit it's dollar 100% and these are dollars. Okay. Select all the dollar values and so make them right click, format cells, currency, and this is English dollar, US, yes. This should be United States dollar. Okay, got it. So I don't think this value, this it is considering it as a text, so it is not working. So what I do is Control H. I will replace dollar with nothing. So it automatically replaces all the dollar symbols in the data. Okay, now all the dollars are properly currency format. They are numerical format. When you click and see here, you can see number values. You don't see any dollar. Dollar is because it is a currency, it is showing dollar. Next is this should be 16,000, not units. And this is number. When it is a number, comma will be missing here. If comma is existing there, it is not considered as a number. Anyhow, so what we do is we take all the numerical values. This is a numerical, this is a numerical, and equipment residual value. This should be a dollar actually. Okay, anyhow. So again, what else numbers are accounts receivable, payments receivable. These all are numbers. So right click, format cells, take number. It's up to you. You want to take decimals or no decimals, it's up to you. Just format the data. Next, this should be a dollar. I will take currency here. Okay. So then, okay, no problem. So otherwise, go to format and make it currency. So little confusion for the tool itself because here we are taking currency. This is currency option. It is giving accounting option here. So anyhow, we handle those things. Now let us take percentages. Useful life, that is number. This is percent. This is percent. This is percent. This is percent. And this is percent. And this is percent. We make it percent. Okay. So we make this percent because what happens? Sometimes text it is considered as a text. Sometimes maybe we remove it. It is 1000%. So actually it is 100%. So this is in percentages only. Otherwise, we take this one here is equal to and we rename it to test it whether it is working as a whether it is working as a numerical value or not. So when we see this one means 100%. Like this, we handled everything that is required here. Okay, we have land, year of sales, all the values, we can take it straight away. Otherwise, if you don't want this one, you can remove this one also. You can just take like this, you can take cut, otherwise delete. So like this also you can take. You have all the values. So this method is not required. So as we are taking only input values, this is option. We make it little bit forward and we make this little bit forward. And this is also when we take debt, then we are supposed to pay interest on that. So, and all these values are like this. So like this also you can take. All right. So otherwise you can keep them. So you can keep them like this too. Okay. So now you have input values. Now let us take decision parameters. From the data, if you properly read the data, you will understand what are decision values according to me. So now these can be your, at last we can take this one anyhow. So these are your values. You can make it up and down or you can change the name values. So in financial mix, equity or debt, what is your option that you should write? Okay. So these are your input values. It means for decision parameters. We create scenario analysis and we perform sensitivity analysis using these values. Okay. So create these parameters in a separate sheet. Okay, you can take up and down. You should consider this as a single one. Okay. So remaining, it's up to you. So this is a single financial mix that contains two different values. So you should keep both the things along with each other. Okay. Now let me go with calculations part. So let us make a revenue table. You can take year like this or year and 1, 2, 3, 4 like this up to 10 years. Otherwise, I take according to me, I like this way one. Here maybe like I can say year 1, year 2, like this I can make a table. So whether you want to make table in columns or table in rows, it's up to you. Okay, so I can show you in both ways. Okay, let me take year 1, year 2, like this. So I will take up to year 10. Here also I take year up to 10. So this is all. First I will calculate revenue for each year using regular format revenue, and this is equal to from input parameters how many units, this one, into what is the price per unit, this one. Let's enter. Now it was given in the decision parameters that what is the yearly growth. Yearly production growth is 10%. It means that whatever the value we generated, that should be multiplied by 10% increment. Okay, so what we do, this is equal to 10% increment means this into 1.1. 1.1 means whatever the 100% plus 100% plus 10%. What it is? 110%. So why don't we use 110%? 110%. Okay, let me do this. Okay, 880. So this value now C2 into input parameters of this dollar, this 7 means we should make a reference cell. So this is also C3 into 110%. Otherwise, you can take parameter growth, maybe like 1 plus decision parameter 10%. So I will mark it dollar rate $2. Okay, it should be dollar. And I will drag it till end. It will generate certain values. Similarly, if you take here, revenue will be coming this side. So it's up to you. You want to do in this manner, you can do it is equal to in input parameters. We have total units production multiplied by total price. So we have 8,000 rupees. Okay. So next is equal to this into how much it is growing. 10% growing means into 1 plus I'm taking decision parameter this one and I'm making it a reference cell and closing it, press enter and click tuck tuck. It got the same thing. How you want to use it's up to you. So I want to use this style, so I removed it. I got on our revenue table I'm having, and next I need operations table. Now create table like this, and you're supposed to calculate all operating costs. Now what is labor cost? So labor cost we can directly take it from inputs. So we have input and in input labor year one we have $200,000. Okay, what is SG and A in input parameters? We have SG and A. We take it. What is utilities? They have an input table. Utilities. They are having utilities and maintenance cost. And now depreciation. Depreciation is equal to. So actually there is a equipment cost over here. Equipment cost minus residual value should be the residual value. And now we take total year value. So useful life 10. Okay, this should be divided by input parameter 10. Okay, so this is depreciation value and we should sum all these things, all these values to get total cost per month. Okay, now it is given that in decision parameters labor cost will increase every year by 3%. So what we should do? Okay, let us name it calculations and let's make it output. Okay, renamed it. Now this one will increase by 3%. That means 1 into 1 plus what is the labor decision? 3%. Okay, so now we put these two things in bracket. So every year it is increasing by 3%. This is not calculations B3, this is input parameters or the decision parameters B3. So now you have 3% increment. So from this is C18, now this is C19. Like this it is increasing every year and these values are common for all years. So maybe we should use a reference variable over here, dollar and dollar, because same value will be repeated for all the years. And here also it is a reference variable because it is repeated for every year. We are taking a static reference and this should be static reference dollar dollar, here dollar and here dollar and dollar. Okay, so now I'm making it here. Now we got total costs. So this is how we calculate operating costs. So create table like this. Here 1 to 10, inventory, accounts receivable, accounts payable, and change in net working capital. So now to create this table, just select inventory percentage. So inventory we should calculate. Inventory is 10% of the inventory. It is given here in working capital inventory 10%. Just multiply it with in calculations every year total costs are there like 20, it is 10% of COGS. So we are taking value of that one. Here what we should do is like the input variable should be a reference variable and cost variable will be same because every year cost should be updated. Okay, so we just give value to one particular thing, one particular element. Like here we this is common and this will be continuously changing. Like for first one it is C18, right? G18. For second one, it is G19. This value will be common for everyone. Okay. Now let us see costs, accounts receivables. Here, accounts receivable. Where is that? My sheet. Here, account receivable. Usually, account receivables will be on the revenue that is generated, and accounts payable will also be on accounts or revenue that is generated. Just follow the formula is equal to this one is equal to go to revenues, first revenue, multiply. So not multiply, it is divided by 365 into 365 into input revenue accounts receivable. This is the formula C3 divided by 362 into input variable. That is the input variable should be a static variable, right? So I am taking static, making it static. So this is the formula and I should run it. All values should be different. It's again same formula. This is equal to go to revenue here for year one divided by 365 into we need a static value of accounts payable. This is accounts payable. I will make it a static. Okay, so this is static and just run it. Everything will be done. So make them all decimals. So I'm making them all decimals to 2. Okay, so now I will sum up all these things. This is net change in working capital, and this is net change in working capital that we should calculate, and we calculated it. So next and final table is for cash flows. Cash flows. Okay. So let me take first years, 1 to 10 years. So this is generated, and what I need to do, I need to take values. Now let us calculate the model. So for the first year, first we should take. So here the capital investment is initial investment that is identified from the input parameters. Maybe so let me take like this sum of these three values. Okay, C2 to C3, C4 values according to me. So this is the value, and this is equal to um, minus F2. So this should be year 0 actually. So let me change this year 0, year 1, and now let us increase it up to 10. EBIT here is this is equal to what are the revenues? Revenues is operating cost. Revenues minus costs. Okay, so continuously mark it like this. Okay, 45, 50, 43, 59, 54. So this is done, and let's make it 2 units. Okay. Now taxes. For taxes, we should multiply this with taxes parameter inside the value. Okay. Corporate tax is 25%. So let's make it static, and let's calculate this. So now make it 2 decimals. Now this should be EBIT minus taxes. So this is net profit after tax. Now this is EBIT means EBIT value minus tax. So EBIT value is total revenue minus total cost for each year, and taxes is 28% of EBIT value. And we are removing taxes value from EBIT to make it net profit after taxation. Okay, so this is the format. Now we need to calculate operating cash flows. Now here we are supposed to calculate operating cash flow, which will be a total of this value and depreciation value. So what we do is we calculate this, we add this with depreciation value, this one. Okay, so and we calculate it same for everything. This value is operating cash flow. So this value is operating cash flow. So this is initial capital, right? For remaining years, what we can do? So usually for all other values, it should be zero. So I marked everything zero. Okay. So now we need to calculate net working capital. So let us take working capital values. Okay, I calculated all working capitals. Now free cash flow value. Let us implement the formula. The value is operating cash flow minus capital minus net change in working capital. So this is the value of free cash flow. Yes, there is small change. This value should also be the same. So we should implement the formula and we get this value. Okay, so this is how it should be. Now let us calculate NPV. These are the three important outputs that we should calculate. So now let us take the formula. This is equal to, the formula is calculate NPV of what is the rate from input variables. Um, we have interest rate here 5%, comma, go to calculations, take free cash flows from here to here, comma, and initial cash flow, this one, enter. This is net present value. Next, internal, let us calculate internal rate of return is equal to IRR of take all values of free cash flows, everything. Now press enter. 25% is the return rate. Calculate payback period. It is very important that first we perform cumulative frequency values. So cumulative means every year we should add previous year value to the present year. So in the first year we have minus this one, and the next year we should add the previous year value plus present year value. Like this, if we do for all the years, so let us give numbering for each year for our understanding. So now this is, and this value we will be using it actually. Okay, so in the year, so this should not be counted. Sorry, from first year itself we should count for 10 years. We see that after fourth year it is converting into positive, right? So then this value will be which year it is before the year, like it is becoming positive, you should take that year plus, and you should take absolute value of that particular year and divided by next year. So 4.24 4.24 years, 4.24 years it takes to get payback, and this should be a dollar, and this is percentage, and this is time. So we see that NPV value is positive. NPV value which is positive, 0 or more is the acceptable value. Larger the NPV value, larger the acceptance of the project. And IRR value, it is internal rate of return. So we have invested this value, and by the end of 10 years, we are having this much value. Considering the depreciation and other values, what could be our rate of return, internal rate of return? It is 28% internal rate of return we are getting. Next one is payback period. The investment that we make, in how many years we are getting a return. We can see that after 4 years, we are getting return. To make it more accurate, 4 years, 4.24 years we are getting. It is approximately 4 year 3 months. Okay, 4 year 3 months or 4 year 4 months maybe. So like that, we can identify, and this is a very smaller time. If something we are getting such a big for such a big project, if we are getting something which is less than 4 years, is 5 years is a good value. So based on all these values, we can we can understand, and we can perform analysis, and we can come to a conclusion that whether the project that we have selected is a good or not. Okay, so this is simple calculations, inputs all in one sheet, outputs all in one sheet, and we have four different calculation tables, one, two, three, and four tables. And you can arrange them according to, like, if you want to remove this one from here, click Control X. So using Control X is more suitable. And Control V here. Automatically table will be moved to some other place, and all the values will be replaced. Okay, so just remove this one, delete. So you can see no impact on values when you use Control X and Control D. Okay, so rather than using these values here, we can keep, I will cut this one, and I will keep it here. So this makes more sense, I guess, and it won't impact on output also. So you can see these values here. Using these values, you can straight away you can calculate it. After fourth year, we are getting a payback period. Now you can generate scenario values using decision parameters. So let me check with the PDF what it was asked in the requirements. Okay, so here it is my PDF, and FIN5823. So this is a scenario where we should use it. So let me make some changes to these two values, and I will generate a scenario value. Say for example, production growth, if I take 5, how it will be impacting the value. So it got increased or reduced of values. You can cross check with the value. So maybe I take actual value here, actual value. Okay. So at 5% value, and let's make it maybe best case. So what could be the values? Okay. So what I do first, I will, like this, I can see, and in the input here, I will make it 10%. So what values we got? Just we write it here: 2445, 525 here, 28% here, and 4.24 is here. So this we should manually calculate, and for these values what we are getting, let us see. Okay, so let's make the variables for this one into, I will changing 5%. So I'm checking how it is changing. So when it is 5%, the value is 1357286.5. This is became 19%, and let me check this one in calculations. Um, this is fourth one. It is taking almost 5 years. So let us implement the formula. This is equal to 4 plus absolute value of this value divided by this value. Very small change in this formula we should use. When this is 5%, the value becomes, now we have values. Okay, so it shows that when the NPV value is decreasing, all the values are decreasing. So it means that when the production growth increases, maybe all these values might increase. So let us take scenario analysis, insert data, and goal seek. Here we are having under what if analysis, go to scenario manager and add scenarios. Scenario name, scenario 1. Changing cells should be decision parameters. Maybe these two values I'm changing, and click OK. Okay, sorry. It should be, we have to give separately these two values. Click OK. Sure. They're asking to start it here in active sheet. So this scenario manager adds scenario 1, changing cells B2 comma B3. Okay, so give values maybe 15, and this should be 4. It should be 4. Okay, and add one more scenario. SCM scenario 2. Okay, add values for B2, make it 25, and B3 method, let us reduce 0.2. Okay, so 2. Okay, click OK. Then now let's click on summary. Um, okay, scenario summary. I got scenario summary here. So scenario 1, it is 5%.